Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. I'm so glad you're here. Well, it's Friday. We made it to the end of the week. What do we got going on in the markets today? Well, we're in rally mode. The Dow's up about 300. NASDAQ's up about 200. All right, so we talked about this. We made a short-term bottom yesterday probably, and we're rallying off that bottom, right? Okay, the market trend is still lower. The major trend is still going lower, and we're going to go lower. But right now we got at a support level, and we're bouncing off that support level. Look at the S&P. It was trading around 39.50, and we bounced off that support right up to around 4,035. Now we could get up a little bit higher for maybe 4,100. You see, there's gaps. There's gaps still above us, and they're right around the 4,100 level, and we might come up and fill those gaps before we head lower. Okay, but the market's going to head lower. Now, what else told me that we were going to get this little short-term rally? It's a temporary rally, I think. I think the main trend is still downward, but I looked at the junk bonds, the HYG. Now, as you saw the market coming down, the junk bonds were actually starting to go up a little bit, and that told us that we're going to have this turnaround. It was a signal that we're going to get a bounce, and we're getting that bounce right now. And like I say, on the S&P, we could bounce as high as 4,100, let's call it, before we head lower. I still think we're going to take out those October lows down around 3,400. We'll see how that all plays out. That's just my take on the market. Yours may be completely different. All right, so let's get over to the real estate market. Well, what we got going on in the real estate market is, well, not much. There's not many transactions going on right now. Now, why is that? Why is that? Well, we got both the buyers are worried and the sellers are worried. Now, the buyers, they're worried because they don't want to jump into a market that's going to continue to go down. So they're worried. They're not buying. And we got the sellers worried. Now, what are the sellers worried about? Well, they're worried if they put their house on the market that there's no demand, that the buyers have went away. So we're kind of in this standstill. We're in a standoff. Now, who do you think's going to win? Will the sellers win or will the buyers win? Well, I think that if the sellers reduce the prices, the buyers will come in. But they have to reduce them by quite a bit, and they don't want to do that. They want to get that price that Billy Bob got. Now, how did we get here? How did we get to this point that we're at? How did we arrive at this housing bubble, the biggest bubble the world has ever seen? Well, the Fed, they financialized the housing market, okay, meaning that they was an investment for Wall Street, right? Okay, so the Federal Reserve, they kept those rates at zero, and they gave corporations money at 0% interest to go out and buy houses. Well, they gave them the money. They could do with it whatever they wanted, but they couldn't find a return on their investment. So they went out and they bought all these houses up. Okay, they bought about 1 out of every 3 houses sold in the last 2 years was sold to an investor, to the corporation, if you will. All right, so they were giving them money, 0%. These companies like Open Door, companies like Zillow. Now, Zillow has gotten out of the market. Companies like Redfin, they're also exiting the market. OfferPad would be another one. But they come in with all cash and they bid against the retail investor, right? Okay, so they bid against them. So the Federal Reserve, by keeping rates at zero and handing it out to the corporations, well, they financialize the housing market. It's no longer just shelter. It's no longer just a place to live. It's now a financial investment. We got the boom going, right? Ever since 2009. You see, in 2008, we had that subprime mess and houses started to come down, came down about 34%. But you see, the Federal Reserve, they hate when the housing market comes down. Now, why is that? Why is that? Well, the reason is that the housing market, well, the real estate market in general, is responsible for at least 20% of the GDP. Okay, and they don't want the GDP to fall, so they got to keep the real estate market propped up. Now, it's also responsible for about 50% of the wealth. And that's a worldwide thing. Real estate is responsible for wealth. Now, when real estate goes down, the wealth disappears, right? And they don't want wealth disappearing. They don't want the GDP dropping. So they'll do whatever it takes to keep the housing market inflated. Now, they went one step farther to keep the housing market inflated. What did they do? Well, they bought these mortgage-backed securities, started buying them around 2009, and they started buying mortgages, right? So they could keep the rates of mortgages, and they kept them low. They got them down to about 3% for a very long time, and everybody bought their house there, right? Okay, they were buying 50 billion of mortgages every month, and they eventually wound up with $3 trillion of mortgages. Once again, financializing the housing market by keeping rates artificially low. Now, do you think we should have a free market housing? Do you think we should let the market decide where a house should be priced at? Do you think we should make the government decide? Have the government support the housing market and they decide where the prices are. You see, now the government, they can create as much money as they want to keep the housing market from falling. They have an infinite supply of money that they can create, and they can keep your house up here. They can keep it up here, but here's what happens. The value of the money goes down, right? So it really hurts a lot of poor people when their money goes down. When they go to the store to buy groceries, they can't buy groceries, can't afford it because the value of the money went down. But that's the only way they're going to keep this houses at this elevated level. You see, this bubble is bigger than 2008. It's the biggest bubble we've ever seen. And to keep this bubble inflated, they're going to have to keep creating money. And I'm not talking about just little money. I'm talking about 10, 20, 30 trillion dollars of money to keep your house at the level it is now. Now, a lot of people want their house to stay at the level, and I don't blame them. They just bought it. You don't want that house to go down by 50%, which is what will happen if the Fed does not continue to create money and keep your house inflated. Okay, so do we want the Fed to financialize the housing market? Is this a good thing? Well, maybe it is, maybe it's not. But what's happened now, we've got to a point where it's completely unaffordable. Nobody can afford to buy a house. Now, if your credit score is 800, you've got a 7% mortgage right now. 7%, that's the best you can get. If your credit score is 800, now you realize if your credit score is like 650, you're paying over 8% already. You're paying about 8.4%. If your credit's down here at 640, 650. Okay, now I do think that the mortgage rates are going to get to 10%. Now, what's this going to do to the housing market? What's going to make the prices come down? It's going to make the prices come down a lot. Now, can we handle that pain? Can the Fed handle that pain before they start to print money again, before they start to create money out of thin air and get that house bubble, blow it even bigger? Maybe they can blow it even bigger. It's possible, right? Now, I don't think that's the way they're going to go, because that will send us in to what's known as hyperinflation. But I don't think we really want the Federal Reserve to control the housing market. Okay, so now I talked about how 1 out of every 3 homes was bought by an investor, by a corporation, if you will, by people buying houses that don't really need a place to live. They just want to make money on these houses. Now, here might be a solution. Look, if you want to financialize the housing market, somehow you got to make shelter affordable. All right, so, well, there's a couple of options. One, you could have no property tax on people that are owner-occupied, and you could triple or quadruple the property tax on the ones that are investor-owned. Okay, now that could equal out the playing field a little bit, right? It would keep the investor out of the marketplace. So there got to be a way to keep the investor from buying up all the shelter that families need, that people need a place to live. They need a roof over their head, and they need to be able to afford it. But if you could financialize the housing market the way the Fed Federal Reserve is, financialize it now, people cannot afford to live. They can't afford the rent. They can't afford the mortgage. So I think you're going to have to penalize, and I hate saying that. Now, the Federal Reserve brought this on themselves by not having a free market. If you have a free market, everything works out just fine. But if you have it subsidized by the Federal Reserve giving corporations money at 0% to go invest in the housing market, by keeping mortgage rates at 3%, if you don't have a free market, you're going to run into the problem. So the problem's got to be solved somehow. And that problem, to get people to be able to afford the house, you have to penalize the investor. And I hate that plan. I hate that plan. I think you should just go back to a free market. But if they want to keep creating money out of thin air, creating money, giving it to the corporations. You see, when a corporation goes to buy the house, and I'm a real estate broker, and I've seen this a couple times where the corporation, they come in with all cash offer, 10% above the list price, and here's the mom and pop trying to buy shelter for their family. They come in with 5% down. They're trying to get up to that ask price, but they can't get there. Well, who gets the house? Well, of course, the corporation gets the house. The investor gets the house because they come in with all cash and it can close like that. And it's at a higher price. See, this is just wrong. You gotta level this playing field somehow. I don't know. I don't have all the answers. I don't have any of the answers, but perhaps a property tax on investors until we get back to a free market. Now, this market is starting to become more free, right? I mean, with mortgage rates up around 8, 9, 10%, you're going to get that demand is really going to go away, and the prices will really start to fall really quickly, right? So maybe that will just correct itself, and we won't need this property tax on the investor. Now, I believe in investing in houses. I believe in that. I mean, it's a great investment, but only if the playing field's level. I don't believe in the corporations just coming in and raiding the housing market and taking everything away from the mom and pop. I don't believe in that. I really don't. I don't think there's any need for that. But that's what the Federal Reserve, they created, right? By buying the trillions, literally trillions of dollars of mortgages. Now, you see, now here's the funny thing. They say they're starting to sell off. They want to lower their balance sheet because their balance sheet's up here $9 trillion. And $3 trillion of mortgage-backed securities and about $6 trillion of treasury bonds. Now, they're starting to sell it off, but they're selling off the treasury bonds. They're not selling off the mortgage-backed securities. Now, here's why. Well, they're letting them run off their books, right? They're letting them run off the books. Now, treasury bonds, they expire, and they're just not renewing the treasury bond. They're not buying it again. So it runs off its books. Now, on the mortgage-backed security side, it takes 30 years for these mortgage-backed securities to run off their books. Now, it's true when someone sells their house and they get a new buyer that comes in with the new loan, that one gets paid off. But you see what's happened here. We've kept the rates at zero with 3% mortgages. Nobody's selling their house. So these are not running off the books. The Federal Reserve still has those $3 trillion. Now, this is a problem that they created and they brought it upon themselves. And they come out here like they're the big hero. They're going to fix the problem by selling these off. Well, first of all, they're not doing it, and they're no hero because they created the problem, right? They're the problem. They're the one that financialized the housing market. They're the one that took away the shelter, affordable shelter for the average family in America. And this is wrong. We got to get back somehow to where the average family can afford the average house. And right now, we're not there. We're in it's the most unaffordable ever been on record right now. I mean, we're at extreme values in the prices, but also now with mortgages going from 3 to 7%, we're at the most unaffordable ever, and that's why it's not sustainable, and that's why my opinion is that the housing prices will come down. They will adjust themselves if the Fed stays this rate. Now, if they turn around and go right back to 0%, which they probably will do eventually, probably as soon as the next recession hits, which should be later this year, they're going to do the this thing called a pivot, and they're going to come right back down, and we still have a financialized housing market. We cannot have that. You have to penalize the investor if the Federal Reserve is going to continue to keep interest rates suppressed and not let the market be free. Now, anyways, this was just my little rant for a Friday. I hope you enjoyed it. If you did, give me the thumbs up. Why not? It's Friday. Get out there, everybody. Have a great weekend. Got a lot of good stuff to talk about with you next week. Bye-bye now.